How's it going, guys? We have some pretty darning evidence that hedge funds are lying. They're lying who? Lying to the FINRA people, and that is ridiculously bad. If you guys saw the video of us finding out exactly who should go to jail, well, this time it seems that hedge funds are going to legitimately be in serious trouble. We just saw a major rip in AMC earlier today, and it is still seeing one red candle, one green candle after another. Major volatility, and only an hour into market has already seen a volume of 2.5 million for GameStop, but over almost 40 million for AMC. This is a story that is relevant for both parties, but the data here will be GME specific. However, lying to FINRA is something that hedge funds who have shorted both AMC and GME are specific to. So make sure to strap in, make sure to have everything you need, right? You need your coffee, you got it here. You need your $10,000 pocket of money, you got it here. You have your like button smashed and your subscribe and notification button smashed so you start investing in yourself. You got it right there. And with 5,000 of you in the live chat, let's get going. So back again with my colleagues derived SI after it generated so much discussion last week. They do not wish for these threads to spark pixel-like content for the sub. Oh, that's a little bit of shade, with daily retorts and updates from myself, my colleagues, and people posting retorts as their own threads. So they will keep the threads to a weekly or twice weekly at this rate. So anyway, a short volume today on the 12th of Friday, right? This is from 1 day ago, but it was posted by Renzel as part of his daily DD, which means that he has given his thumbs up of approval. We have these percentages over here with a specifically, look at this, his SI percent range of 69, nice, now 690% to 1,000%. Daily notes: oddly slow day as fat call options expire, as they were being bought by thousands minutes before market close. Extremely low long volume, retail just holding. Hey, that makes sense. We have a brand new type of creature in the stock market. Not bulls, not bears, just apes, and that is exactly what we're seeing here. So that's for the daily notes on Friday, and then new notes from this data. It's getting to the point where short sellers would literally need to be 80% of all off-market and long volume trades to be under 100%. They changed the formula for the cost of OM volume to match the lowest price of the days, as the off-market is mainly dark pool trades. New conclusions: we can conclude that the percent of volume used for covering is far less than their conversion of 30.75% since the 15th of January as a result of the big old FOMO rally from retail and a bull effort from institutions hogging up that volume. Therefore, it's not crazy to derive that the SI percent is over 700%, with a cost well over $5 billion to do so. Now, that said, we have to be careful about what exactly is the truth. Is FINRA calculating a different sort of truth, or are the hedge funds lying? That's a very different set of allegations, and we're going to cover it. We're going to talk about it exactly here. AMC looking pretty darn good right here on the left hand side. That's where the price action is, and that's why we're looking at that chart right now on the top left. Important notes: what they found, a tendency for these short sellers to get cocky and not cover on weeks when you would have expected them to. This means that some weeks with low SV percent had huge net gains in shorts. This never worked in reverse in the data. Proof that FINRA data is impossible. If you were to take the FINRA data from the 15th of January to 24th of February, you would find that they would needed to cover using 30 to 32% of all transfers for the entire month and a half. What does this mean? Well, let's just make it as clear for the smooth brain to understand. Proof 1, it would have been impossible for them to comprise that portion of the covering with the FOMO wave and gamma squeeze that was hogging the data at the time. This 30 to 32% is notable. There was a considerable boost in daily volume in that period. So if you're talking about a minimal cost of 34 billion, that's 34 big ones right now, using my formulas from my previous data, that being a bare minimum amount, just to lower it to SI percent, they said it was at plop up, blank, blank, blank. Proof number 2, we have not witnessed a loss of 22 billion USD or more from institutions in that time. That would have seen a net loss, by the way. No bankruptcies were seen either. I said above that I noticed that short sellers who did not cover when the data suggested that they had the opportunity, that this trend never reversed. A high weekly SV% yielded a net gain in short positions. This is what Trey and the other 4 Holdeman keep saying, right? And the very beginning, I postulated 2 of the 4 of them, I guess the 4 of us, that if they were to cover, they would have a long time ago. So the win condition for you is essentially guaranteed. If the lose condition for us is that if they go all the way back down to a point that they could cover, they would have covered back when GME was in the 40s and AMC was in the 5s. So there you go. AMC still holding strong at that $13 range, but 1 red candle from its high. Proof number 3, SV% has remained over 50% throughout the 15th to 24th period, which provides evidence of a net gain in shorts, not a complete dip of the SI. Lastly, if all this was the way they said it did, then the stock price would not have dropped during the period if they had covered. The data heavily implies that shorts are used and held to stop upwards momentum. So right now, the proof, it seems, is that there isn't a money trail. Right, we're looking at this much money to cover that cost, and it seems like they did not have that much money. Right, they did not witness a loss of 22 billion from or more from institutions at that point, even though the calculation says that it does need a minimal cost of $34 billion. And finally, it looks like that the price didn't move, and we know that if they cover, that is coerced buying, and that would have caused the price to move upward. Right, we haven't really seen a lot of that. His response to the feedback. Short volume percent of total volume can't reliably tell you how many new shorts have entered or covered that day, because below a market selling you a share that because of this, a market maker selling you a share that they haven't yet matched up with an actual seller, but due a few seconds later will get counted as a short position momentarily. This apparently can and does happen and gets counted in the short volume, meaning exactly no new short positions were taken, but the short volume went up anyway. On the flip side, it does tell you the absolute highest number of short positions that could have taken that day. So new short positions could be anywhere between 0 and the high short volume amount. But due to the above, as well as shorts entering and covering in the same day, means you can't really glean anything from it reliably. Sorry. Oops. What you are describing would create a net neutral movement on the share price, which was not seen. More importantly, the data I acquired clearly shows that there is a net gain of shorts when compared to the long volume day after day after day. It is possible, but the data says that there have been creating more shares than they can possibly cover, even if they were 100% of the long volume every day, which we know is 90% algos and day traders. So they look at things from scientific lens. All I aim to show was that it's financially and numerically impossible for the SI% to have lowered since the 15th of January, which we saw consistently from 80% in 2 weeks, from 4 weeks ago to 60% 2 weeks ago, and from last week we saw it down to 50%. It was the running assumption that everyone who believed in this and I provided darning evidence for it being the case. All right, so there's a little bit more about this conversation. This is just what this person is trying to respond. 1 and 2 comments here. I guess there isn't a tool I didn't read, but the main tool I didn't read is this, that you are looking at a impossible situation, that FINRA has been lied to or is knowingly changing the way that the percent is calculated, and every time we wait for it, we are just like everyone else in the financial world, waiting for a number that is ultimately false. And how can we prove this? Well, with mathematics, right? With how markets have historically reacted to shorts covering, and finally, with your own research. This was not financial advice, and we are not financial advisors. Something that you have to understand is that when you do your own research and you discover these kinds of rabbit holes, you will find how deep it will actually go. So if you like this video, make sure to like it. If you guys want to subscribe and invest in yourselves, you know that the subscribe button is right there waiting for you. So for now, but not for forever, I'll see you on the moon.